Hello, good afternoon, and a very warm welcome back to you all. Thank you for joining us for this BKL Budget 2020 webinar. I'm delighted to say I'm not in self-isolation. Joining me today to help me slalom majestically through the checks and gates of yesterday's budget, we've got David Wiscombe. Hello, David.
Good afternoon, all.
And I'm very pleased to say the tax partner here who makes me feel like a Southerner. I've got my other David, David Simpson.
Good afternoon, Southerner.
So, good afternoon to you all. Yesterday's budget, not too many surprises, but let's see what we can drill down and excite you about today. As always, do let us know if you have any questions. Do type away. We'll do our best to answer them, either during the webinar or hopefully if I manage to press the right button and save them, we'll come back to you afterwards. So without further ado, let's start with the News at One budget headlines, and if you want to give me some bongs, gentlemen, I'll be most grateful. But these were the headlines that I had from yesterday. I think the one item that had been trailed very heavily was the changes to ER. In the end, it was scaled back but retained and subject to some rather sneaky anti-forestalling rules that we'll talk about. Corporation tax, as had been trailed, wasn't reduced to 17%, but stays at, I think, broadly reasonable 19%. And there's been a few other minor tweaks that we'll drill down on capital allowances and the R&D regimes. IR35 changes, sadly, perhaps unwelcome, but again, no huge surprises there. A little bit of tinkering over the past few weeks and months, but they're coming into place in April. The good news for business, some rates relief and enhanced time to pay arrangements, particularly in these uncertain times. And we now have further details on the SDLT surcharges for non-residents that will take effect from 2021. So those were the main changes. I think it's also fair at this point just to flag up some of the things that weren't in the budget that we're expecting. There'd been a long and detailed consultation on IHT reform. Absolutely nothing on that, unless you guys have spotted anything I haven't. We did dodge a budget on ER to a certain extent, insofar as up to £1 million, you're still okay, of gains. No changes otherwise on capital taxes, and again, one possible change that have been trailed quite heavily were changes to pensions tax higher rate relief. Well, David, you'll talk to us about some of the minor changes made to pensions, but the good news is 40% relief stays. Fuel and alcohol duties largely unchanged again. On the other side of the coin, though, we were hoping that there might be some changes to SDLT rates to encourage the housing market, and by that I mean reduction in the rate of SDLT, but alas, nothing there. So that's the budget in a nutshell, and we will of course drill down into all that. Gents, general feelings on the budget, David?
Well, I liked the way that the Chancellor was described in the FT this morning as thinking of himself as Santa in a hazmat suit. That image appealed to me immensely. But look, he's had an immensely difficult task, and only time will tell whether what he's done is up to the mark.
Fair enough. So the first coronavirus and Brexit budget, David, how was it for you generally?
I mean, it was clearly a borrow and spend budget, but there does seem to be a policy shift in the government such that they seem to be happy with an increased level of deficit and borrowing. So from a tax perspective, it didn't feel to me that the increased spend will automatically lead to tax increases down the road. I think the government is intending to maintain this increased level of borrowing. So my takeaway from this was, apart from the measures being announced, it isn't a case of spend today and pay later. There is a policy change to just increase the level of debt in total. I guess my main question, if the Chancellor was in the room, is how is he actually physically going to spend this wave of cash that's been thrown at the public sector and various areas of investment?
Yeah, well, we will see. We will see. So let's start, if we may, with, as I say, what have been, I think, horrendously leaked were discussions about entrepreneurs relief. And in the end, a bit of a halfway house, really, David, I suspect. We're back sort of where we started, but do you want to fill us in there?
Yeah, well, it was not as bad as it might have been. There was a lot of rumour before the budget that entrepreneurs relief might be abolished altogether. There was a certain amount of pushback against that from the business sector. And anyway, in the event, entrepreneurs relief lifetime limit gets reduced back to the £1 million that it was when it was first introduced in 2008,
yeah.
I think. Yeah. So, and in fact, when the limit was increased from £1 million to £10 million, I remember that there was some ambiguity of response, particularly from the professional sector, because it now meant that instead of potentially getting it wrong to the extent of the difference on of 10% and capital gains tax rates on £1 million, you can now get it wrong to the extent of £10 million. So your PI exposure went up tenfold, which was a bit worrying. Anyway, we're now back to £1 million of lifetime limit. To the extent that you have already used more than £1 million of relief under the old rules, then no further relief is going to be available after 11th of March. If you've already used relief, but the amount you've used is less than £1 million, then the balance up to £1 million remains available for disposals after 11th of March, as you would expect. As you might not expect, there are no transitional rules at all on this. So it applies to disposals on or after 11th March. But even if the business ceased to trade before budget day, but the disposal is being made after budget day, you're still fixed with the £1 million limit. So there's no transitional rule for a pre-budget cessation. No transitional rule even if your disposal is associated with an earlier disposal that was made before 11th March. And even if the gain is a deferred gain, which has been rolled forward or on reinvestment or deferral and crystallizes on or after 11th of March, even that will not benefit from any transitional relief.
Which compares to when they extended the 1 year minimum holding period, etc., to 2 years, there were specifically some reliefs in there, weren't there? For example, if your business had ceased.
That's right. There were specific transitional rules, but this is very, very simple and straightforward. The bigger surprise is the anti-forestalling rule that's been brought in. As you know, there was much planning being contemplated. I'm not sure quite how much was done before the budget, taking advantage of the rule in section 28, which is the rule that says where an asset is disposed of under a contract, which is subsequently completed, the capital gains tax disposal date is the date on which the contract is entered into rather than the date of completion. So there was a lot of planning contemplated before the budget using uncompleted contracts, entering into contracts before the budget but completing after. That in most cases will prove not to be effective because of this anti-forestalling rule. And what this is saying is that this new limit of £1 million will apply to contracts that are completed on or after 1st of March, even if the contract was entered into before the 11th of March, so disapplying section 28, and unless the taxpayer can certify two things. One, that no purpose of entering into the contract was obtaining an advantage by reason of the application of section 28, and also either the parties are not connected parties or the contract was entered into for wholly commercial reasons. So in many cases, the planning that was undertaken in order to anticipate the ER changes and take advantage of the pre-budget limits is not going to be effective. There is similarly an anti-forestalling rule that applies where there was a reorganisation before 11th of March, a paper-for-paper exchange, a share-for-share exchange, and again, where broadly speaking that was undertaken for a tax avoidance purpose, the new £1 million limit will apply rather than the £10 million limit.
I mean, we've had anti-forestalling provisions before, but I thought this was quite extraordinary given how much information about this potential change was already in the public domain, to suggest that people would not think, is there any sensible tax planning I should do pre-budget, and that should be seen as offensive. I find quite extraordinary. Yes, we accept the point, I think, if there is a very artificial transaction, but where somebody has genuinely sold a business, an asset that qualifies for ER just before the budget, and completes after, it seems extraordinarily harsh. As you say, it's not the main purpose or one of the main purposes. This is absolutely nothing to do with the change to ER, is broadly the wording in the legislation.
Yeah, I mean, I'd be interested to see if this anti-forestalling rule is even potentially subject to challenge as being a retrospective legislation. Because the fact is that people have entered into transactions before budget day in the expectation of a particular tax treatment. That particular tax treatment is not now going to apply to it. It's at least arguable that might be regarded as a retrospective legislation, and possibly one might even see challenges through the courts on that basis. Though taxpayers haven't been particularly successful in challenging the revenue on judicial review in the courts recently. But it's interesting to see how that would pan out.
Okay, we've had a couple of questions from Graham. Thank you. Perhaps we'll deal with one now, and Graham, we can pick up on the other later. Graham, and we'll come back to this when we talk about IR35, I suspect. But Graham's got a company that went into liquidation before the 11th of March. Some of the distributions were post 11 March. Are the post 11 March distributions subject to the £1 million limit? Graham is asking.
Yeah, because the disposal in that case will take place at the time at which the distributions are received.
And it's not strictly governed by Section 28, I think, on a liquidation. I think
no, Section 28 is about assets disposed of under an unconditional contract, and so it has no bearing on liquidations.
Good. So I think we agree. And Graham, if we may, we'll pick up on your other question offline. Okay, now that's the changes to ER. I think, as I say, a lot of clients, I think, are breathing a sigh of relief that we keep the £1 million. What about investors' relief, David, given how closely, what bedfellows they are?
Very interesting that no change whatsoever to investors' relief. And as the comment has been made, I think it's fair comment, but it kind of gives the impression that the government are perhaps more interested in favouring investors than they are entrepreneurs. It might be slightly unfair analysis, but you can see where that viewpoint comes from. So investors' relief completely unchanged.
Okay, all right. So some good news there. So those are the changes on entrepreneurs' relief. Say, depends, I suppose, if your glass is half full or half empty. Let's move on to some of the other business changes then. Corporate capital loss restriction. Again, no surprises here. This is something that had been trailed previously. So, as I'm sure many of you are aware, back in April 17, the loss relief rules for corporation taxes were changed. Generally good news. They became more flexible. Brought forward losses, for example, could be group relief, but there was a sting in the tail where you had losses in excess of £5 million. There was this £5 million deductions allowance. So if you wanted to carry forward losses, but say had profits of 10 million, yes, you've got a £5 million offset, but then you can only use losses to offset half of the difference. That was the £5 million deductions allowance. Capital losses have now been brought within this. So after 1 April 2020, where you're making chargeable gains, and substantial chargeable gains, because, as I say, you've always got your £5 million deductions allowance, you can only use up to 50% of those gains, offset 50% of those gains by using your brought forward allowance. And I think the point perhaps I hadn't fully appreciated, but what we're saying is this is not an additional £5 million deduction allowance for capital losses. It's aggregated with the deductions allowance you previously had of £5 million for trading losses, etc., brought forward. Now, HMRC say 99% of businesses won't be affected by this, and probably right, to be fair. It's only where you have profits in excess of £5 million and you're looking to use brought forward losses that you will need to consider this from 1 April. So hopefully that won't have too much of an impact going forward. So those are your new corporate capital loss restrictions. R&D. These rules have been improved steadily since the regime, or the regimes were first introduced in, I think it was 2000. Thank you, David. Okay, for SMEs, where are we? Well, HMRC had been concerned about fraudulent R&D claims, particularly where, for example, work had been purportedly subcontracted overseas. You can claim under the small SME regime for subcontracted R&D. Typically, you get 65% of what you pay your subcontractor. And if you're loss making, you can make a claim for a credit equal broadly to 1/3 of your qualifying expenditure. HMRC have now reintroduced a cap on that credit, so it's now 3 times the company's total PAYE and NIC costs. Originally it used to be 1 time, so sort of back where we started, but more generous, 3 times. The crumb of comfort I can give you is these changes have been pushed back to 1 April 2021, so we've got another year before we have to worry about this cap. I just reiterate though, it's only if you are claiming the credit. It's not if you are just claiming the deduction because you are profitable. Hello, David. David asks about the £5 million limit we were just talking about. Is that divided by the number of group companies? Well, that £5 million limit applies to the group as a whole, so it's not strictly divided as such or prorated. You can choose how you allocate that 5 million across your group. So that's that. Back to R&D. R&D expenditure credit. Well, this started, I think, was it 10% it started at? I think so. It keeps going up, doesn't it? Went up to 11 to 12. And again, I think this has been largely trailed, although not officially announced. The good news is we're going up to 13% for expenditure incurred after 1 April. Well, actually, that should say 1 April 2020. Apologies. So good news. The Chancellor also announced further incentives, R&D support for distilleries to go green. Good news, David. I think you'd agree there.
I'm not quite sure what distilleries going green means. If it means they're going to stop making single malt whiskies and produce chartreuse instead, I think it's a rotten idea.
Yeah.
But on the assumption that it means that they're going to produce less pollution, well, yeah, it's obviously a good idea.
Yes, here. And I think there are also various incentives, grants and funding announced for companies wishing to undertake R&D that are sort of out with our tax regime. But all in all, good news. David, did you want to add something?
Yeah, just on the cap, I think the government also announced that it's going to consult further with industry on the design of this, with a view perhaps to tailoring it a bit more. So although it's been definitively pushed back to 2021, I don't think the 3 times cap is necessarily going to be the final figure either.
Okay, well, we shall see. All of this, of course, is just draft legislation at the moment and subject to change. So we shall see, but thank you. Okay, and to be honest, there wasn't an awful lot on business taxes. David's going to cover some of the anti-avoidance rules later, but just a few other points to flag up. The Structures and Buildings Allowance was introduced in 2018, gave a 2% writing down allowance for the construction and modification of buildings. That now goes up to 3%, so from April 20, so all good. Plastic packaging tax. This is going to be introduced from 2022. It's going to incentivise the use of recycled plastic. If you don't have your plastic with at least 30% recycled materials, you'll pay £200 per tonne of packaging. How and they'll exactly police that, I'd love to see, but I think we'd all agree with the principle. One other small change, the intangible assets regime. So again, this is purely for companies, and as a general rule, follow the accounting treatment, or you get relief for the amortization of intangible assets, albeit goodwill no longer generally qualifies. There was a restriction where you bought an intangible asset from a related party, and that intangible asset was created pre-2002, i.e. when the intangible assets regime was introduced. It remained outside these intangible asset rules. You sort of traced it back to its original ownership if it's a connected party acquisition. Now, the kindness of the hearts, HMRC are relaxing that restriction, albeit, given goodwill is out with these rules, generally speaking now anyhow, it's hard to imagine there can be much value in other IP that was created prior to 2002. So seems to be. I think
there are also some anti-avoidance rules about shifting assets around between related parties before they're acquired by the company. So it's still, there are still some more complex provisions on it.
Okay, so we'll look at the detail there, but I don't think it's going to have a major impact. This was a slightly odd one. Large business notification. From April 2021, large businesses will be required to notify HMRC when they take a contrary view to HMRC's policy. That really opens up a can of worms, doesn't it? So we'll have to look at the detail there. David, did you want to add something?
I think this one's actually been taken directly from the US tax practice. You have to notify the IRS if you're taking a position on an uncertain outcome in US tax. So I think this has just been pilfered from the US tax code.
fair enough. I mean, we've always had internal debates, haven't we, about disclosure, etc. if you are taking a potentially contentious view, but I suppose they are just formalising something that we would, in many respects, regard as good practice. So we'll have a look at the detail there. I'm not quite sure. Have they defined what we mean by large companies for these purposes? I'm not sure if they have yet, but okay, we'll see. But we've got another year before we have to worry about that. Now, as we said, this is the first sort of coronavirus and post-Brexit budget, and certainly, as we've already referred to, this was a somewhat generous budget in many respects, and the Chancellor, in light of current economic uncertainties, has given enhanced breaks in respect to business rates. There was previously a 50% break for retail properties with a rateable value less than £50,000. The good news is he's given a complete holiday, as he calls it, from 1 April 2020 and expanded those businesses that can qualify to include hospitality and leisure, which I assume is purely because they're the ones most badly hit at the moment. So a complete rates holiday, all good news, although it's a complete cliff edge as well. If your rateable value is £51,500, you get nothing at all, but there you go. There's enhanced relief for pubs, and for no other reason than it just made me chortle, there's a relief for public lavatories as well. So there you go, complete your own punchline, please.
Well, relief in public lavatories, I mean, what more needs to be said, really?
Indeed. So that was that. Similarly, the Chancellor's aware of the fact that businesses are struggling at the moment and may struggle to pay their tax. He announced there'll be an extra 2,000 HMRC staff to assist with time to pay arrangements. I didn't know they had 2,000 staff anymore, but there you go. So in theory, if you are struggling with your tax liability, give them a call. You should get a sympathetic ear, and it should be possible to arrange a payment plan with them. They've also mentioned the possibility of waiving penalties and interest if you've had difficulty in contacting HMRC due to the virus. And related to that, various loan schemes are being introduced to support businesses in this time of need.
Yeah, this extra 2,000 staff is a bit double-edged because it also comes up under the anti-avoidance rules that seems to be once sort of finished facilitating deferral arrangements, they'll then be redeployed onto full-time collection duties.
What the Lord giveth, the Lord take away. Yeah, and I have to admit, my experience with them is they haven't always been particularly sympathetic in the past when we've approached them about entering into such arrangements. Hopefully they will be in the current climate. So those were the main business changes. I just flag up there are certain reviews that are announced, so watch this space, albeit given we had this huge review on IHT and nothing's happened, but there's going to be a review on EMI share option arrangements, asking the questions, is it really focused sufficiently at supporting high growth companies? And should more companies be able to access the scheme? I'm not quite sure what they mean by that. Do they mean broader industries, or are they going to increase the threshold of the size of businesses that can qualify? We will have to see, but I think hopefully that's going to be positive changes. Slightly odd one for R&D tax credits, talking about extending it to data and cloud computing. Well, if they're doing cutting edge work, I'd have thought they're in there anyhow. So again, we'll await the details. And there was a further announcement of a review concerning the UK funds regime, which is always, I've found, somewhat complex. So if there's any simplification there, both from a direct and indirect tax perspective, that will be most welcome. So those were the main business changes. So we'll come back to anti-avoidance a little later. Let's now pick up on where we previously were as far as off-payroll working, and known to you and I as the IR35 changes. David, over to you.
Okay, I mean, this is not something that's been introduced in the budget, of course. This is something that's coming in from 6th of April 20, but was announced before the budget. Draft legislation was provided before the budget. And what this is all about is, as you say, IR35. Now, IR35, as we all know, is the anti-avoidance rule that's been in place for 20 years now, which counters avoidance of pay as you earn, and more especially national insurance contributions, where you interpose an intermediary, usually a company, but not always a company, between somebody who would be an employee and somebody who would be an employer. And where that applies, of course, broadly speaking, the intermediary is required to operate PAYE on everything that is received under the contract. So there's no change to those current IR35 rules, provided the end user is not large or medium sized. Problem is that in most cases where so-called off-payroll working operates, the end user is large or medium sized. There are not that many end users who are small. So this introduces to the private sector the same changes that were introduced to the public sector with effect from April 2017. And the government have been so pleased with how easy and straightforward and simple the operation of the new rules in the public sector was, that they've decided that they'll be perfectly simple and straightforward and introduced into the private sector as well. You can make your own decision on whether that's a wise judgment or not. So large or medium-sized means, broadly speaking, companies that meet at least two of the tests: turnover of more than 10.2 million, gross assets of more than 5.1 million, or more than 50 employees. Though it is actually worth remembering that there are some companies that are excluded from being treated as large or medium-sized under these new IR35 rules. If they are not able to access the small companies regime for Companies Act purposes, then equally they're not able to access the not able to be treated as small for IR35 purposes. So in particular, there are companies in the financial services sector who, although they may be financially small, are effectively treated as large or medium sized for this purpose. And where these new rules apply, it's reasonably simple in principle. The end user determines whether the IR35 rules ought to apply. And if the end user determines that the IR35 rules ought to apply, then the operation of the rules is not left to the intermediary company. It's the tax and NI is deducted by the payer, whether that payer is the end user or whether it's an agency lower down in the chain. So broadly, end user determines whether the rules apply, and payer payer operates them. The anecdotal evidence is that a lot of end users, particularly banks, are responding to this simply by saying, you know what, we just won't use people, we won't engage people through companies any longer, we will simply take people on as employees, which is presumably the sort of response that the government was hoping for.
Yeah, they're doing their work for them, aren't they, is the bottom line. Denise asked a question. So David, you said it's then the payer who has to deduct tax and NIC. Denise, thank you for your question. She asked, can the end user lawfully reduce the day rate by the employer's NIC? Because the point is here, we've got a deemed employee, so it's not just the deduction of PAY and NIC as a cost to the provider of the services. We are correct that there's employers NIC also to account for here.
And if the contract is that a payment will be made of X pounds, then the payment, it's as if a salary has been agreed of X pounds. So PAYE and NI will be applied on X pounds of payment, and if that imposes an additional employer's national insurance contribution, then the national insurance contribution is payable in addition to the quote salary, as it is with any other salary.
So it's really a legal question to a certain extent as the contractual arrangements, but I think going forward, no doubt the engagers, the banks, etc., in our example before, they are going to have to factor into that cost, and they may well reduce their day rates to take into the fact it now costs them more to engage this individual.
Yeah, almost certainly.
So it is ultimately going to be borne by the end users, we suspect. Now, this is a huge topic. I mean, we've flagged up the main issues there, and we get this complete mismatch between the legal agreement between the parties and this tax fiction that is now one of employee and employer, and it certainly complicates the accounting and tax of that intermediary company. And so I think we've agreed, David, haven't we? Great excitement that we'll do a further webinar on this next time, or we'll drill down into all of these issues into more detail.
I can scarcely wait. I can scarcely wait. I mean, and it is worth just making the point at this stage, however, that this does not make the workers employees, unless, of course, the contract is changed to make them employees. But the mere operation of the IR35 rules doesn't make them employees as a matter of general law. It merely means that pay as you earn has to be applied as if they were employees.
So really, the contractor has the worst of both worlds, doesn't he? He's suffering all these taxes, which in HMRC's view he should have done anyhow, to be fair, but he gets none of the protection he would have as an employee, both with regard to employment rights, statutory sick pay, etc., etc.
Yes, though without anticipating too much the excitement of our next webinar, some of these workers may or may not be Limb B workers and therefore entitled as Limb B workers to certain protections, even though they're not employees, and that itself is opening another whole new kind of world.
We'll save that till next time, but that's the headline, and I think we'll just flag up at this point. It has led to an awful number of these personal service companies being wound up, as people are now being forced into direct employment, as HMRC would always have liked. So that's all we'll say on IR35 until next time. We're now going to have a look at some of the changes impacting on personal tax. So over to you, other David, who's going to talk us through some of these.
Thank you, Tony. I think I'll be picking up personal and international tax changes. Obviously, the headline change in the personal tax regime is the raising of the primary threshold for nooks to 9,500 from April 2020. As with the change in the personal allowance in the last government or in the coalition government, this is a hugely expensive measure. It's been costed at 11.5 billion just to raise it to 9,500, and the government is regarding this as a down payment on the move to bring it into line with the personal allowance at 12,500. But obviously, the sort of government's figures is they expect that this to put £100 a month into everybody's pockets.
Okay.
And there's a couple of minor other changes on the slides, which I'll leave you to read yourselves.
Okay. So moving on.
I think you skipped one.
Have I skipped one? Nobody panic. There we go. Oh, I've gone forward again, haven't I? Apologies. There you go. Sorry, Dave.
This slide is just largely confirming. Actually, there's no change to many of the rates. So the dividend and savings exemption is unchanged. Savings income at the 0% rate is unchanged. The adult individual savings account is unchanged at 20,000. So I think the only one I would draw your attention to here is actually a very generous increase in the child ISA, the junior ISA. So if you are putting money away on behalf of your child, or you have clients that do, this is more than doubling of what's allowed. I think on the financial advisors are saying that if you do this from a child from birth at these rates, that they'll end up with a pot under obviously certain assumptions of something in the region of £350,000 when they turn 18.
All good. Yeah.
So that should actually pay off or prepare them for their student debt.
Yes. Okay. Right, now pensions.
Okay, this was a more interesting change. I mean, Tony touched on at the beginning of the webinar that there was some concern, probably in the months leading up to the budget rather than immediately before the budget, that higher rate tax relief was going to be tinkered with, or certainly there was going to be adverse changes. In the event, actually, we had a slight loosening of the pension tax rules. So we have the annual allowance of 40,000, and that remains unchanged. But what has changed is the tapering rules, which restrict the annual allowance for high earners. As you'll all be aware, this has been driven by concerns over the consultancy in the NHS, and dealing with their concerns, they've had to roll it out to everybody at some expense. This is expected to cost a couple of £1 billion. So under the current rules, pre-6th of April, there is a reduction in the annual allowance of £1 for every £2 you earn in excess of 150,000. That 150,000 has been kicked up to 240,000. So NHS consultants obviously do quite well.
It's quite a substantial increase, that, as you say, and it's, I think, somewhat surprising in the current climate.
Yeah, so it's a very generous increase. There are actually two thresholds for pension purposes. Currently 110 and 150, they're both being kicked up by 90,000, so the relevant figures are now 200 and 240,000. So the expectation is all but the very highest earners are not going to be affected by the taper now.
Okay.
The one change where they've tried to claw a little bit back is the floor for the reduction in the annual allowance under current rules is 10,000. That's actually going to be reduced to 4,000, but you only get into that reduction once your earnings are in excess of 300,000. So I don't think too many people are going to lose too much sleep over that.
No, nice problem to have in many
Exactly.
respects. Okay, so as you say, generally pretty good news there. So all good. Let's just move on now to some of the CGT changes on property. I think all of these have been trailed previously, haven't they, David? So it's just a case of perhaps reminding and summarising where we've got to.
This first one has a curious history behind it. So the rule, or the new rule, is that lettings relief, the £40,000 letting relief associated with principal private residence, will now only be available if the letting was the owner was actually in occupation with the individual who was actually had a room in the principal private residence at the time. So as of 6th of April, it's a strict cutoff. If you didn't meet that condition at any time in the past, you can't bank the lettings relief. It's simply lost after 6th of April for a disposal after 6th of April. But the reason why I say it, a curious history to this, I remember this suggestion of dual residence was actually first floated in respect of renter room relief. It wasn't originally on PPR, and it was an anti-Airbnb measure when it was first floated, and it was actually retracted on the renter room relief, but they obviously decided they needed to find a home for it and have attached it to the PPR rules. So it's a rather curious how this one's come about, but it's you know, if you have a PPR which you're selling after 6th of April and you were hoping to get the lettings relief, and obviously if it's a couple selling, that is 40,000 times 2, it's a fairly significant restriction on the relief available. The second one is one that it bounces about over the years. Currently, regardless of whether you're using the property as your PPR at the date of disposal, the last 18 months are deemed to be PPR is available on that. That is a figure which has bounced about over the years. I think when it originally came in, it was 12 months, then it went up to 3 years. It's now currently been cut back to 18 months, and it's now been cut back to 9 months. Obviously, generally not good news, but who knows, it may increase. It tends to be tied into the properties of the fortunes of the property market, so it may increase in the future. It may, of course, be abolished in the future, but as of 6th of April, it is now 9 months.
Okay.
And the final one is, it's probably one that's going to hit individuals or have a more immediate impact than the two measures above. This is if you sell a property after the 6th of April that doesn't benefit from PPR, so you've actually got a tax bill to pay. You now have to pay that tax within 30 days of completion rather than reporting it through your self-assessment tax return. So it can be a very significant acceleration of the tax point.
Yeah, no, I think that's fair enough. It doesn't affect the amount of tax, to be clear. It's just, as you say, when you have to pay it. So those are the property changes we've picked up on. Now we're going to move on in this brave post-Brexit world to some of the international tax changes that were announced yesterday, or in some cases confirmed yesterday. All yours, David.
Yeah, I'd almost like to pause at this time. Given that it was very much a spend budget, it's a lot of it's quite surprising in a way that there was absolutely nothing said about Brexit in the budget. But as we're all aware, we are leaving. The transition agreement is going to end on the 31st of December, and as things look at this moment in time, we'll be exiting our arrangements with the EU on a no-deal basis. Now, a lot of our tax code has been formulated due to EU obligations over the last 30 years. And one of the things that we need to consider is how and to what degree there's going to be fundamental changes to the tax code as a result of coming out of the EU. And one of the ways to look at this is our policy over the last 30 years of when we've had to make changes as a result of being in the EU, we've tended to do it in one of two ways. We either think it's not actually a bad idea, the change that we were having to make, and therefore, rather than just restrict it to member states, we make the change on a global basis. And therefore, we bring in the Americans, etc. Or we really don't like what we're having to do, and therefore we make it as restrictive as possible, and therefore we'll only extend it to EU member states to the minimum degree possible. And I think the changes which have come through in the budget illustrate both approaches quite nicely. But I think as a more general thing, it's worth bearing in mind how we do this to assess the likelihood of the measure surviving beyond 1st of January next year. So the first 2 points are both issues where we've extended the relief globally. So the first point is loss relief for loans to traders. So this is, under the current rules, if you make a loan to a UK resident trader and that loan goes bad, you can claim a capital loss, notwithstanding that the loan itself is not a chargeable asset.
And this is for individuals, to be clear here, isn't it?
Yep.
Yep.
That has been changed with effect from the 24th of January, that the UK residence requirement is being dropped. So if you make a loan from the 24th of January and it goes bad at least before we leave the transition rules on the 31st, you can get a capital loss on that loan. Who knows what happens after 31st of December, but on the basis we're doing it on a global basis, it may survive. The same rule or a similar approach has been adopted where you have subscribed for shares in a company, in a trading company, which meets various definitions. That company goes bust, and you've actually, the capital loss you realize under certain conditions, you can actually claim income tax relief on. Under the current rules, one of those conditions was that the business had to be carried out wholly or mainly in the UK. That condition is being dropped as of the 24th of January 2019 as well.
Okay.
And again, so under the new rules, that business can be carried on anywhere, and if you meet the other conditions, you will get your income tax relief on your capital loss. The reason for 24th of January is that is when the EU Commission issued us with a reasoned opinion saying that these rules, as currently written, were contravening the EU treaty. Contrast those two rules with the third rule. So this applies where the UK is a member of a group, a member of a corporate group, and it transfers an asset to a non-resident group member who is based in the EU, and they do mean the EU EEA. It has no relevance to companies resident outside those jurisdictions. Had you made that transfer from a UK to UK company, relief would apply to have the transfer on a no gain, no loss basis. Because you can do that, there's discrimination, and there's a complicated history to this, but because of that discrimination by not extending that relief to intra-EU transfers, the tax which otherwise arises can actually be deferred for 5 years under these new rules, which is to bring it into line with European case law. However, I think the government's made its intentions quite clear on this. The rules actually contain their own provisions for repeal, which allows them this provision to be repealed by secondary instrument. It doesn't actually require primary legislation to be repealed. And they will repeal it if we leave the EU, for instance, they've said. So I think you can take this one. This is a very temporary measure that is going to disappear on the 31st. The 5-year deferral, though, in itself will will be disapplied if the recipient sells the asset or the group relationship ceases to exist.
Okay.
And it does apply from accounting periods and ending after 10th of October 2018, and applies to tangible assets under the TCGA, intangible assets under the intangible asset regime, and loan relationships.
All right, so catch it while you can, I think is the message there.
Well, I think it would be more, is it worth the hassle of applying for this deferral relief, given you know it's going to disappear?
Okay.
We mentioned at the beginning of the webinar the 2% surcharge on non-residents buying UK property. We've pulled this into the international dimension simply because, or into this section, simply because such a measure would be illegal under the EU treaties, because obviously it's a discriminatory measure against EU citizens, amongst others. And therefore, this measure is being deferred until April 2021, when we've actually left the transition agreement with the EU. If that gets extended, in the unlikely event that's extended, then this measure would need to be deferred again.
Just to be clear, this is in relation to only in relation to residential property, I think, isn't it? It doesn't apply to commercial property.
Correct. That said, there is no detail being given around this. The government introduced a consultation paper when it first floated the idea. There was a response to that, but the government hasn't actually announced any of the details as a result of that consultation. The expectation is that the definition of non-resident is a self-contained one for the purposes of this SDLT surcharge. So in the consultation document, you were a non-resident if you didn't live in the UK for 183 days in the prior 12 months to the date you bought the property. And alternatively, if you bought the property and then lived in the UK for 183 days in the following 12 months, you could get a refund of the surcharge. Okay. But it's yet another sort of self-contained residence definition.
Again, so okay, we'll have to watch this space for the detail. So let's move on to the digital services tax. Again, this has been largely trailed beforehand, and I suspect won't affect too many of our clients. So do you want to just quickly summarise for us, David?
Indeed. I've put this into the international section, although legally it applies to UK groups equally. But you'll see the size threshold in the first indent. It only applies to groups with digital service revenue in excess of £500 million, of which 25 million of that needs to come from UK users. So although I saw in the press this morning, there's some concern that groups such as Just Eat will be caught by this. It's generally understood that this has been aimed at the US tech giants, and that's certainly the way the US Treasury is looking at it. The actual tax itself, although you might not be impacted by this directly, it is something that's going to play out in the press, so I'm just going to quickly cover it. The tax itself is a 2% tax on UK generated digital revenue, not profits, revenue, related to social media platforms, search engines, and online marketplaces. And for each of these, you could think Facebook, Google, and eBay. And it's quite a chunky tax. It's projected to raise £1.5 billion over the next 5 years. Is it a legal tax is going to be one of the questions. If it's a turnover tax, it's illegal under the EU treaty. If it's properly characterised as a profits tax, then it is in breach of our double tax treaty obligations. So it's almost certainly going to go to court, given that I don't think Google and the like are going to take this sitting down. The other big issue on this is the US government response. The French tried to introduce something similar, and they were browbeaten by the Americans, who said they were going to slap tariffs on them if they did it. They've already told us that if we go ahead with it as we're doing, they're going to slap tariffs on our car exports. So this one's going to play across the press considerably, I think, in the coming months. One thing just to mention on it, this concept of digital service revenue, the idea behind this is that such digital players derive value from the interaction from their users, and that isn't that value creation isn't captured properly. And this idea, whether you agree with it or not, is included in the Pillar 1 proposals from the current OECD negotiations, is exploring the same sort of ideas. And the UK digital services tax is going to be withdrawn if the OECD comes to a consensus on global international taxation.
Okay, so again, watch this space. As you say, it's going to form part of no doubt some tough trade negotiations, so we'll have to see. Okay, into the final stretch, as it were. David, do you want to give us a quick heads up on the framework around tax avoidance? What have HMRC announced here?
This is a bit of a mishmash of announcements, really, without any substance behind them. It wouldn't be a budget without HMRC being given further information powers. So they're being given unspecified information powers to prevent the enabling of abusive tax avoidance schemes. There's going to be further technical amendments to the promoters of tax avoidance schemes regime. There'll be changes to the this next one is a bit curious. It's actually very specific. There's changes to the GAR to tackle avoidance around partnership structure, so that suggests they have something in mind. And then the last one is an interesting one, certainly from our side of the fence. There's going to be consultation on the market for the provision of tax advice. It's one of the idiosyncrasies of the UK system that anybody can set up shop as a tax advisor. There's no requirement for professional qualification of the like or registration with HMRC. So this is HMRC, I think, looking to see what they can do to choke off rogue tax advisors.
Fair enough. So forthcoming attractions, as it were. Okay, on a similar vein of tax avoidance, David, there's been some changes announced in respect of the much maligned loan charge. Do you want to just fill us in?
Yeah, just to recap on this. This was the charge that arises in respect of certain disguised remuneration arrangements. They've been in place for many years. It just took the revenue about 200 years to catch up with them and work out what was going on. One of the ways in which those historic tax abuses in the revenues terms was to be countered was simply by the imposition of a tax charge in respect of any loans made under disguised remuneration schemes if those loans were made after 5th of April 1999 and were still outstanding on 5th April 2019. And that was a bit of a draconian measure, and many of us thought it looked an awful lot like retrospective legislation. The revenue persuaded themselves that it wasn't, but anyway, under pressure, the revenue procured an independent review of the loan charge, and that independent review reported earlier this year, and the government have accepted most of the recommendations of that independent review. They're all good news. So that loan charge on loans outstanding on 5th of April 2019 will now completely exclude loans that were made before 9th December 2010. It will also exclude loans made before 5th of April 16, provided what the revenue called reasonable disclosure was made at the time and the revenue failed to take action. So if the revenue ought to have done something about it and didn't, then they lose the chance to tax it under the loan charge relaxation. And finally, where there is a loan charge, that can now be spread over 3 years instead of 1, which reduces the tax a bit. So it's all good news.
Okay, thank you. And following on, as far as tax avoidance goes, there's a couple of changes that were previously announced concerning company insolvencies. So just very briefly, this is sort of the private eye tax, as it were. HMRC clearly take offence at people who use insolvency as a way of avoiding tax liabilities. So if a company's been undertaking something the revenue regard as avoidance or evasion, it's then subject to insolvency procedure, and there's an individual, typically a director, although he may not legally be a director, connected with the company who's been responsible for the company's conduct, and all of this leads to a loss of tax. Then the bottom line is HMRC will come after that individual for the tax, who is now joint and severally liable for its payment. The other thing HMRC used to, continue to object to is so-called phoenixism. You have a company, it owes tax, it goes bust, it goes under, HMRC don't get their money, and we'll talk about priorities in a minute, and lo and behold, you reform or are involved with a company that undertakes similar activities. The gist of these rules is if you've done that a couple of times in 5 years, then again, HMRC will come after that individual personally. So I think we can have some sympathy with them
I think
people who undertake such planning.
In principle, you can see where the revenue are coming from. It's just that the devil's in the detail, as always.
Yes.
And you want to be important to see that it's actually properly targeted.
Yeah, I agree. And I mean, we mentioned there's a right of appeal, but it is difficult. There's a degree of subjectivity about some of this, isn't there,
Indeed,
as to
yes.
who's culpable and who was planning what. So that's the first leg of it. The second leg is this. When the Enterprise Act was introduced, I think 2002 again, wasn't it?
Sounds about right.
Sounds about right. HMRC's position in the queue of creditors was significantly reduced, certainly for liabilities arising before the appointment of an insolvency practitioner. They were an unsecured creditor. Now, HMRC like nothing more than companies acting as their debt collector. So companies will typically collect PAYE, NIC, VAT, there's the construction industry scheme, etc., etc. HMRC's view is that shouldn't be, they should have priority for those debts. It's not a liability of the company itself, and therefore HMRC are now a secondary preferential creditor in respect of those debts held by the company on behalf of their customers and employees. The rules remain completely unchanged if it's the company's own tax, i.e. its corporation tax or employer's NIC. And again, I don't think arguably too controversial, but it's got a very mixed reaction from the insolvency profession, from what I can see.
It seems to me to be not unreasonable, because what the revenue are saying almost is these amounts that you've collected from other people, you're almost holding in trust for HMRC. And there is an argument that says they shouldn't be available to other creditors at all if they're held in trust for HMRC. But
yeah, I think that's a fair comment. So, quick word on that stamp duty, and then we'll finish with a couple of points on VAT. David?
Okay, this is a very technical change to the stamp duty, but we're going to mention it as it does impact corporate reconstructions, particularly demergers. I would just emphasize on this, when I say stamp duty, I do mean stamp duty. This is not SDLT we're talking about, it is stamp duty. So prior to FA 16, if you were doing a demerger, you could normally, the stamp charge was normally 0.5% on the assets being extracted in the demerger. And that you could actually normally, I don't want to use the term avoid, you could plan around by something called swamping to essentially make that charge disappear. In FA 16, the revenue tightened up the rules, not against swamping itself, but in a somewhat unilateral way, which had the effect of tripling the amount, the effective tax on the assets being extracted. And the 1% increase from the half to 1.5, you couldn't do anything about. There was no planning around, or no serious planning around that. That had a lot of pushback because it seemed to create very random outcomes. So what's happened in the budget is the 2016 changes have been relaxed, and in 50-50 demergers now, you generally won't have to pay that increased charge. But they have gone back and actually brought in rules to deal with swamping, which means you will actually end up paying the 0.5% charge that the revenue think you should always have been paying prior to FA 16.
I think these changes take effect from royal assent, don't they? So I think the window arguably is still open if you're brave enough. So thank you. Those are a couple of stamp duty points. Very bravely, I'm going to now just mention a couple of VAT points. This I think came from, it was the News International this case came from. So you buy a paper, you pay VAT on it. Sorry, zero, you don't pay VAT on it. If it's an e-copy, then previously you did pay VAT on it, and that was seen as a little bit harsh. And it's a bit like, the Spurs trophy count at the beginning of the season. The answer is going to be zero. It's just a case of how you get there. So they've now announced from 1 December 2020, all publications to be 0 rated, and the so-called tampon tax. There's been a lot of noise about this in the past. Abolition of VAT on women's sanitary products, that's going to take effect from the 1st of January 2021. One of the positive news, VAT postponed accounting. Apparently we're going back 35 years here as to how this used to work before the EU. I think the principle here is you import goods, typically you pay import VAT at the time you import them. Going forward, you're only going to have to account for that import VAT as part of your normal quarterly VAT return process. So we're talking about timing here. Primarily, it now means you pay the VAT later. And again, construction services domestic reverse charge. This was meant to be introduced, I think, last year, wasn't it? It was postponed to do with abuse of VAT in the construction services. Very much sort of mirrors, its scope very much mirrors how the construction industry scheme works. Look, I've put a link to our website there that sets out how that works in full detail. I'm sure one of our VAT consultants will be happy to explain that to you in more detail. And indeed, David, I think you've written a paper summarising the budget that's on our website, and there's plenty more on there covering all of the tax changes we've talked about and BKL services generally. You can also sign up there for David's erudite brass tax briefings, etc., which will make you chortle and perhaps teach you a bit of tax. So have a look what's on there, and all our previous webinars are on there. You just need to register there. So I think that's where we'll leave it today. I think all in all, not such a bad budget from a tax perspective. Depends what you were hoping for, but no, I think unexpected blows below the waist. So
could have been worse.
It could have been worse. Do we, just a final point, do we expect there to be further changes announced in October, perhaps, that this Chancellor didn't have time to quite get around to?
Well, that's actually worth remembering. There is actually another budget later this year. So having gone since 2018 without a budget, now we've got 2 in 1 year. What excitement!
When will the excitement end? And on that fiery note, thank you, David.
And don't forget our webinar on
absolutely
on the new rules.
As soon as I pin David down to a date, we will of course let you all know. Thank you, other David.
Thank you.
And if you've got any further questions, do of course drop us an email. We will be circulating a link to this webinar and a copy of the slides hopefully later today, so you can listen to it again as if the excitement was enough. But thank you very much for joining us. I hope you've enjoyed that. Thanks. Bye-bye.